Hey, welcome back. I'm Zane, and before we get into today's topic, I need you to stop whatever you're doing for just a second. Because what I'm about to share with you isn't just interesting, it could literally save you $10,000, maybe more. Here's the scenario. You wake up one ordinary morning. You make your coffee, shuffle to the mailbox, grab the usual stack of envelopes, maybe a bill, maybe a coupon flyer, and then you see it. An official envelope from the Internal Revenue Service. You open it, and it's not a refund notice, it's a penalty, a big one, $10,000. And the worst part? You have absolutely no idea what you did wrong. You weren't hiding money offshore. You weren't running some shady operation out of your garage. You were just doing what you've always done, managing your own money, living your retirement life. And yet, here's this penalty notice, sitting right there in your hands. This is not a hypothetical. This is not some worst-case, one-in-a-million scenario. This is the new reality for a growing number of retired Americans in 2026. And on today's Senior Security Update, we are going to break down exactly what is happening, why it's happening, who it's targeting, and, most importantly, what you need to do right now to make sure it doesn't happen to you. What exactly is this $10,000 penalty? And why are retirees getting hit? Let's start from the top, because to really understand what's going on in 2026, we need to understand a rule that has actually been on the books for decades. It's called the Currency Transaction Report, or CTR. A CTR is a standard financial form that your bank is legally required to file with the federal government anytime a cash transaction exceeds $10,000. That could be a deposit, a withdrawal, or a transfer. Anything over that threshold gets reported. Now, here's where it gets interesting. This rule itself is not new. Banks have been filing these reports for a long time. It's routine, it's legal, and under normal circumstances, it's really no big deal for the average person. So then why are so many retirees suddenly finding themselves in trouble in 2026? Two words: new technology. What changed in 2026 is how aggressively and intelligently the IRS is now using those old bank reports. The agency rolled out a new wave of automated enforcement systems, powerful digital tools that can take all those currency transaction reports and cross-reference them almost instantly with your tax returns, your Social Security records, your investment accounts, your pension history, everything. The system is essentially building a financial profile of you, and it's asking one very pointed question. Does the money moving through this person's bank account match what they've reported to us? When it finds a gap, even an innocent one, it flags it. And that flag can trigger a penalty notice, $10,000 per violation, not a typo, per violation. Everyday transactions that can trigger the system. Now, here is the part that is going to surprise a lot of people watching right now. The transactions that are triggering these automated flags, they're not shady. They're not suspicious in any normal human sense of the word. They're the kinds of things that retired Americans do every single day without a second thought. Did you sell your old truck last spring for $12,000 and deposit the cash? That's a trigger. Did your son or daughter give you a generous financial gift to help cover some unexpected medical bills? That's a trigger. Did you move a significant sum from your savings account to your checking account to pay for a major home repair, maybe a new roof or a heating system? That can trigger the system too. And here's one that catches a lot of retirees completely off guard: taking a lump sum payout from your pension. That large one-time deposit? Yes, that lands right on the automated radar. None of these things are illegal. None of them are even remotely shady. But in a world where the IRS is now using automated systems to look for patterns, they can all look like something worth investigating, especially if your tax return doesn't tell the full story of where that money came from. And I want to be really honest with you here, because this is important. The original intent of this law was never to target regular, honest, hard-working retirees. The goal was to catch serious financial criminals, people hiding large amounts of unreported income, people laundering money, people engaged in major tax fraud. But the problem with automated enforcement systems is that they don't know the difference between a criminal hiding dirty money and a retired school teacher who just deposited the proceeds from selling her late husband's coin collection. The machine sees a pattern, and it reacts. The hidden trap, structuring, the mistake that good people make trying to be careful now. I want to talk about something that I consider to be the most dangerous part of all of this. And it's dangerous precisely because it sounds like something a responsible, careful person would do. It's called structuring. And structuring is when someone deliberately breaks up a large cash transaction into smaller pieces specifically to avoid triggering that $10,000 bank reporting threshold. Maybe you've heard that banks have to file paperwork on big transactions, and so you think to yourself, I'll just be smart about this. I'll deposit $8,000 this week and the remaining $4,000 next week. No paperwork, no hassle, no problem. Here is the brutal reality. That is a federal crime. It doesn't matter that the money is completely legitimate. It doesn't matter that you were going to report every penny on your taxes anyway. The moment you intentionally break up a transaction to stay under that reporting threshold, you have committed what the law calls structuring, and it carries the exact same heavy penalties as everything else we've been talking about. Think about how unfair that feels for a second. Someone does everything right, earns the money legally, plans to declare it properly, but tries to be clever about how they deposit it, and suddenly they've broken a federal law. The IRS's position is essentially this. If you're intentionally avoiding the reporting system, even with clean money, it looks like you're trying to hide something. And the new automated systems are specifically designed and programmed to detect exactly these kinds of split deposit patterns. So please, if there's one single thing you take from today's Senior Security Update, let it be this. Never, under any circumstances, break up a transaction to try and stay under the radar. If you have a legitimate large amount of cash to deposit, just deposit it, all at once. The bank files the report, you go about your day, and as long as your paperwork is in order, there is absolutely nothing to worry about. How the new automated IRS system actually works. Let's take a moment to really understand the machine that's doing all of this, because I think it helps to know what you're actually dealing with. Picture it like a very sophisticated, very tireless digital bloodhound. This system is running continuously, 24 hours a day, 7 days a week. It's taking the currency transaction reports that banks file, and it's layering them on top of every other piece of financial data it has access to. Your filed tax returns, your Social Security income records, your reported investment gains, your pension distributions. And it's looking for mismatches. It might see something like, a $15,000 cash deposit landed in this person's account in March, but their tax return doesn't reflect any income source that would explain $15,000 in cash. Flag it. Or it might see, this person made 4 deposits over 3 weeks, each one just under $10,000. Pattern match. Flag it. The speed and scale of this system is something that genuinely should get your attention. A human IRS agent going through paper files might catch a handful of these situations in a year. This automated system can process and flag thousands of accounts in a single day. And it does not pause, it does not get tired, and it does not give you the benefit of the doubt. Now, getting flagged by the system doesn't automatically mean you're guilty of anything. It doesn't automatically mean you're going to receive that penalty notice. What it means is that your account is now on a short list for closer human review. But here's the thing. If that human reviewer looks at your account and they can't find a clear, documented explanation for where a large sum of money came from, that's when things can escalate very quickly and very expensively. Real stories. The faces behind these penalty notices. I want to put some real human faces on this situation because statistics are easy to tune out, but stories are harder to ignore. Consider a retired veteran. Someone who spent 30 years serving this country, comes home, retires, and then sells a piece of land he's been holding on to for decades. He gets a lump sum, deposits it into his bank account, and a few months later he's staring at a penalty notice because his tax return didn't clearly account for that deposit. He did nothing wrong. The money was completely legitimate. But because the documentation wasn't in order, the system flagged him, and the process of proving his innocence was long, stressful, and expensive. Or think about a retired couple, both in their late 70s, whose adult children pooled together money to help them cover a major medical expense. The kids sent the money in a few different transfers over a couple of weeks because they each had to move funds around from their own accounts. From the automated system's perspective, those multiple deposits from different sources, all arriving within a short window? Classic structuring pattern. Flag it. These are not criminals. These are not tax cheats. These are ordinary American retirees who got caught in the wide net of an automated enforcement system that was designed to catch very different people. And the only thing that separated those who resolved the situation quickly from those who faced serious penalties was one thing: paperwork. Your protection plan. 3 steps to keep you safe. All right, I know this has been a lot of heavy information, and I don't want to leave you sitting there feeling scared and overwhelmed. So let's shift gears entirely. Let's talk about protection. Because here's the really good news. Defending yourself against this is not complicated. It does not require you to hire a team of lawyers or become a tax expert overnight. It comes down to a simple 3-step approach. And if you follow these 3 steps, you can go to sleep tonight knowing your finances are protected. Step 1. Document everything. This is the single most powerful thing you can do. Every time you have a large financial transaction, and let's define large as anything over $5,000 just to be safe, you need to keep a paper trail. Sold your car? Keep a copy of the bill of sale. Your kids gave you a financial gift? Have them write up a simple dated gift letter that includes their name, your name, the amount, and the reason. Got a lump sum pension payout? Keep that distribution paperwork in a dedicated folder. Transferred money between your own accounts for a big purchase? Keep the receipt or the contract for whatever you were buying. This documentation doesn't have to be fancy. It doesn't have to be notarized. It just has to exist, and it has to be accessible. Because if the IRS ever comes knocking, even just with a routine question, you want to be able to open a folder and say, here's exactly where that money came from. Any other questions? That's the power of good documentation. Step 2. Get a tax professional in your corner. If your financial life is more complex than just Social Security and a monthly pension check, if you have investment accounts, if you're receiving distributions from a 401k or an IRA, if you sold property or received any kind of substantial gift this year, then 2026 is the year you really need to sit down with a qualified CPA or tax advisor. Not because you're doing anything wrong, but because a good tax professional can make sure your tax return tells the complete story of your financial life. Remember, the automated system is looking for gaps between what your bank reports and what your tax return shows. A skilled CPA closes those gaps before they can ever become a problem. Step 3. Have an honest conversation with your bank. This one surprises a lot of people. You can actually just walk into your bank and have a conversation with them. Ask them about their reporting policies. Ask them how they handle large transactions. Tell them about any big financial events coming up in your life. Maybe you're expecting a large insurance payout. Maybe you're planning to sell some property. Let them know in advance. Being proactive with your bank doesn't just protect you practically. It also signals that you are a transparent, responsible account holder who has absolutely nothing to hide. The bigger picture. What this enforcement shift really means for retirees. I want to zoom out for a moment and talk about the bigger picture here because I think it's important context. What's happening in 2026 is part of a much broader shift in how the federal government enforces financial compliance. For decades, the IRS was largely limited by the capacity of human investigators. There were only so many audits they could conduct, only so many returns they could review in detail. Technology has completely changed that equation. The cost of automated enforcement has dropped dramatically, and the reach of these systems has expanded enormously. The IRS can now effectively screen many more accounts for potential issues than they ever could before. What this means for retirees specifically is that the days of flying under the radar, even innocently and unintentionally, are essentially over. The system is watching, it's learning, and it's getting better at finding patterns every single month. This is not said to frighten you. Quite the opposite. It's said to empower you. Because the people who are going to be caught off guard by this are the people who don't know it's happening. And you now know. The retirees who are going to sail through this new enforcement environment without a scratch are the ones who do two things: stay informed and keep good records. That's genuinely it. You don't need to be a financial genius. You don't need to restructure your entire retirement plan. You just need to be organized and proactive. Quick reference: what you need to know at a glance. Let's do a quick recap before we wrap up, because I want to make sure everything we covered today is crystal clear. The Currency Transaction Report rule has been around for decades, but in 2026, the IRS now has powerful automated systems that cross-reference those reports with your tax returns and other financial records in near real time. The penalty for violations starts at $10,000 per incident. Everyday transactions, depositing proceeds from selling a vehicle, receiving a family gift, taking a pension lump sum, or transferring large amounts between your own accounts, can trigger the automated system if they aren't properly documented and reported. Structuring, intentionally breaking up transactions to stay under the $10,000 threshold, is a federal crime, even when the underlying money is completely legitimate. The new automated systems are specifically designed to detect structuring patterns, and they are very good at it. Your defense is straightforward. Document large transactions thoroughly. Work with a qualified tax professional if your financial situation has any complexity, and communicate proactively with your bank. These three habits will keep you protected in this new enforcement landscape. Closing thoughts from Zane. Here's how I want to leave you today. You spent your entire working life building something: a retirement, a financial foundation, a sense of security. Every dollar you saved, every investment you made, every sacrifice along the way, it was all in service of getting to this point. The last thing in the world you deserve is to lose a chunk of that to an IRS penalty notice for a mistake you didn't even know you were making. This new automated enforcement environment in 2026 is real. It is expanding, and it is not going anywhere. But it is also completely manageable if you know about it. And now you do. Knowledge is your most powerful financial tool. A little bit of attention to your documentation habits today could mean the difference between a peaceful retirement and a very stressful, very expensive audit. So, I want you to ask yourself one honest question before you close out today's Senior Security Update. Is my financial paperwork ready for a fully digital IRS? If your answer is yes, great. If your answer is, I'm not sure, or probably not, then now is the perfect time to start. Not tomorrow, not next week. Now. I'm Zane. Thank you so much for spending this time with me on Senior Security Update. Please share this with every retired person in your life: a family member, a neighbor, a friend from church, anyone who could benefit from knowing what we talked about today. Because this information could genuinely protect someone you love. Stay informed, stay protected, and I'll see you in the next one.